this property, and this property are all pretty bad options for some types of Dubai real estate investors. So in this video I'll tell you about the worst properties, I'll show them to you, I'll back them by data, and I'll tell you about the types of real estate to avoid based on your goals. Starting with the first goal, flipping. For the purposes of this video, flipping means buying the unit at the off-plan stage and then reselling it during construction or at handover. So now I'll tell you about the 5 worst properties if you wanna flip. Number 1. Properties with no price gap between off-plan and comparable ready units. And this is absolutely the worst property you could buy if you wanna resell quickly. Because if there is no price gap, then there is no room for the markup. You won't be able to resell at a higher price. Your target buyers at this stage are end users. These are the people who will live in this property. So they have a choice, buy your unit or buy another ready unit. And the reality in Dubai right now is that off-plan units, many of them, most of them, are priced in line with the ready market prices. And the situation like that basically kills the short-term flipping. If you study the market, I'm pretty sure you saw a lot of examples like that by yourself. And recently, Binghatti announced a new building, an off-plan project, and the price there is $463 per square foot. That's 1.7 thousand dirhams. Let's say you bought this one, and you want to resell it during construction, and you are charging a premium. Why would anyone buy it from you when they can go and buy Binghatti Azur for a lower price? And also mortgage it. Number 2. Projects with unsold stock long after launch. If the developer still has stock, your chances to resell during construction drop significantly. They become almost zero, because buyers see no sense in buying from you when they can buy from the developer for a lower price. That's one thing. And the second one is that if the developer has a huge stock and they can sell the units, why do you think you can? Because this clearly indicates that there is no large demand. Let me show you a real example. Something that is currently selling in Dubai. So the developer says it's a luxurious residential complex, not really luxurious, just a normal one, located in the prestigious Arjan district in Dubai. So they launched this project in July 2024. So it's around a year and a half ago. The handover is planned for the end of 2026. So now they have 15 units in stock, 4 one-beds and 11 studios. So let's say you buy a studio here in 2024 with a plan to resell it during construction. And by the end of 2025, there are still 11 units available in the developer's stock. It means you're competing directly with the developer. It doesn't mean that this project is bad. It's actually pretty good for renting out. But for quick flipping, it's not worth it. Now let's get to the worst property number 3, underperforming developers. Obviously, developers are not created equal. Some of them are better for flipping, some of them are worse. But the good news is that all the data is public. You can go to DLD website, download a huge database with all the transactions that happened in Dubai over the last 10 years. You just have to analyze roughly 1 million different data points and get the ranking of the developers. Fortunately, we did that for you. We took all the properties that were launched and delivered between 2020 and 2025. So now we know what is the value appreciation during construction of all developers in Dubai. Here are only those that launched and delivered at least 2 properties over these 5 years. So here are 3 groups. The first one, the green ones, are those that grew faster than average. The yellow ones are those that showed the growth slower than average. And the red ones are those that declined in value during construction. I won't go into details, because I've already made a deep dive about that in a separate video. You can check it out if you want to learn more. But generally, what you can learn from this, that there are certain developers that consistently deliver the growth faster than the market. And there are some that are underperforming. And it's not about the reputation, and it's not about the size. Many of them are pretty big developers. But even if the developer is in the green category, and it's a great developer, big developer, reputable developer, you can still fail with flipping because of the type number 4. Projects with resale restrictions. If you think that you buy the unit at the off-plan stage and can then resell it during construction whenever you want to whoever you want, I have some bad news for you. Developers actually control this side of things too. First, to resell your unit, you need to get an NOC from the developer. NOC stands for No Objection Certificate. And in the reality, there are cases when they are not providing it. For example, if you're reselling the property at the price significantly lower than the market price. But most importantly, the sales and purchase agreements, they have specific terms related to the moment when you can resell. And it's normally tied to the payments. When you pay a certain portion of the price of the unit, then you can resell. Before that, you cannot. This percentage is different for different developers, and they can vary depending on the project, but here's the general list. If you bought from Emaar or Omniad, you normally need to pay 50% of the property price. Damek and Bengadi require 40%. Ellington, Imtiaz, Iman, Nahil and beyond, 30%. This restriction is not a problem if you want to resell at handover. It's a complication if you want to resell during construction. But even if the developer has no strict terms regarding the payments that you need to pay before you can resell, and if they're from the green category and they're really strong, there are still certain properties you should avoid if you want to flip. These are huge projects with thousands of identical units handing over at once. When too many identical units enter the market simultaneously, it creates a perfect condition for a price war, because landlords, the property owners, they have no competitive advantages. This becomes a buyer's market. All the units are the same, so the main differentiator is the price. In cases like that, when you have so many competitors, it's really hard to flip with a premium. And we saw it several times in Dubai. Here's an example of Midtown. And in Midtown, there were more than 10,000 units delivered almost simultaneously. Over the 4 years of construction, the prices haven't grown much, and even at handover, the overall increase compared to the sales launch price was around 10%. So the question is, where should quick flippers invest? And the answer is early stage launches of unique properties with limited stock. Being in the early stage is important, because the future launches will drive the prices up and will help you to flip with a premium. You have less competition, because the market is not saturated yet, so you have more control over prices. And for the same reason of less competition, it's better to go for the small exclusive launches. And of course, if you want to flip during construction, then the restrictions regarding the payments are super important. And finding a property like that is also priced lower than comparable ready units is super hard. It's super rare in the current Dubai market. That's why the quick flipping market is almost dead. There are exceptions, but they are super rare. For example, Bay Villas by Nahil on Dubai Islands. You know that beachfront supply is generally limited, but villas in the beachfront areas, they're super scarce. And these villas are developed by Nahil, one of the most prominent developers in Dubai. So the demand was massive. It far exceeded supply. And the combination of all those things resulted in some cases when people were able to flip their property with a nice premium in roughly a year, or maybe a bit less. Some of the owners resold their villas with 20-25% upside. So when you know all of that, two important questions remain. Number one, how do you find the properties for flipping with high potential? Number two, if you found one that you think is good, how do you assess it? So for the second task, you should use the ROI Forecaster. This is the tool we developed, and it basically helps you to run investment case analysis. You fill in all the data you have about the property, and the tool helps you to calculate ROI, NPV, IRR, and cash-on-cash returns. And it also helps with cash flow planning. It shows you how much money do you need to spend each year, and how much money can you make each year. And if you are still looking for the right project, you should check out the Insider Report. Insider Report is a PDF document that we created, and it has the information about the most interesting areas for real estate investment, the 10 best ones in our opinion. Then it contains the information about the 10 most reputable, most prominent developers in Dubai, and 20 best projects we recommend our clients for investment right now. Both ROI Forecaster and Insider Report are free. We're sharing them with everyone who wants them, brokers and investors, so you can scan the QR code or click the link below and someone from my team will send it to you. And now let's get to the second goal, the second type of investors, and the second batch of worst properties. The second goal is renting out, so this is for yield investors. And the first worst property in this category is a project in an oversupplied rental zone. Many principles we just discussed in the flipping section, they are applicable for the rental properties too. And the big growing supply in the area is generally good for tenants because they have more choice and now they have the power, but it's generally bad for landlords. Large and disproportionate supply leads to competition, competition leads to rental rates decline, and rental rates decline leads to stagnation of the property prices. So all of that pressures both rental returns and resale potential. And the most famous area in Dubai that faces a big risk of oversupply is GVC. The current number of units in the area is 47.5 thousand. 35,000 more are under construction. So eventually, in just a few years, the area will face the supply of 82,000 units, which is huge. All the areas nearby, GVT, Arjan, Motor City, each of them is 4 times smaller in terms of the supply. So if you're looking for a rental property in an affordable segment, it's better to take a look at these 3, but even them might have properties that are not the best rental investments. Number 2. Buildings with high service charges and other hidden costs. When we talk about rental properties, we often refer to rent-to-price ratio, which is a quick and dirty way to assess the rental potential of the property. But it misses one big thing, which you should absolutely always take into account when you run the numbers for assessing the rental property potential. These are operating costs. They are different among different developers, among different projects, and they affect your profitability significantly. 1 percentage point of your rental yield can be easily reduced because of the service charges. Let's take a look at this quick example. These are the service charges in JLT. The average in the area is 18 dirhams per square foot. In Ellington's buildings, it's 21, and in a new project by Palma Holding, the service charges will be 25 dirhams. And this is not the highest number. There are developers in the lower category with much more simple buildings who still charge much higher service charges. What else you should know about service charges is that their size is not guaranteed to be the same. It can change over the years. By the way, speaking about the guaranteed things. Number 3. Guaranteed ROI projects. There are so many reasons why these guaranteed 10% net rental yield projects are far from being the best rental investments, but let's concentrate on just one group of reasons: economical. And these projects, they're often located in the areas where the average rental yields, gross rental yields, are around 7%. But those guaranteed ROI projects, they promise 10% net rental yield, which means that the gross yield will be 10% plus service charges plus management fees. This comes up to around 14% gross rental yield, which is crazy high. Why would any tenant pay 14% of the property price when they can go to the neighboring building and pay 7%? This is just a part of the story, but it's enough to make this type of property pretty questionable. Number 4. Project that has already passed its main growth phase. There are some projects or residential areas that seem to be awesome, that are super demanded by residents or tourists. Everybody wants to live there, and they're ready to pay the premiums. Like, these residents literally pay the highest rents in the whole of Dubai, and still, there are not that good rental businesses. Because if you're entering this market now, it means that you missed the growth phase. Those who invested 3 or 5 years ago, they're making pretty good money because they entered at the low point. Now when the prices are up, despite the rental rates being high, your yields are pretty low. One of the examples is Blue Waters. Let's say you invested there in 2019 and bought an apartment for 2.5 million dirhams. Today, you're renting it out for 295,000 dirhams per year. That's 11.8% gross rental yield. But if you buy the same property now, in 2025, then the price is 4.9 million dirhams for the same unit. So your gross rental yield goes down to 6%. So if you want to make a successful rental property investment, there are several ways how to approach it, depending on your goals and your timeline. But generally, if your goal is maximizing the yields right here, right now, you should go for affordable, well-managed properties with low service charges and stable demand, affordable communities, and the most affordable units in those affordable communities often deliver the highest rental returns. A high rental yield now doesn't mean that it will be like that forever. It doesn't also mean that the demand will also be high. It doesn't mean that this type of property will outperform the market during crisis. So if you're thinking about things like that, probably you're a long-term investor. If you're a long-term investor, if you think 7, 10 or 15 years ahead, you should concentrate on the things that will not change. You should go for iconic areas. You should go for undersupplied types of properties. You should go for unique concepts, one-of-a-kind buildings. And there are two types of properties that are the worst in your case. Number one, investor-heavy projects with many units in your case should be a no-go. First, because projects like that, they really get hurt during the downturns. During the crisis periods, many investors are selling their assets. Many of them are panic selling, and this inevitably drops the prices. On the other hand, end users, they live in those houses and apartments. They are not getting rid of their homes. And generally, there are certain types of real estate in Dubai that are more end-user focused or investor focused. For example, villas. Roughly 2/3 of all villas sold in Dubai are bought by end users, by people who'll be living there, so they don't go to the market after handover. They are not rented out and they are not sold. With apartments, it's the other way around, and the situation becomes worse when there is a large number of units. One of the examples of an investor-heavy project with many similar units is Azizi Riviera. The chart that shows the average price per square foot is on your screens. So basically, this project increased in value by 35% since 2020, which is quite a modest growth. Number two, projects that are not built for decades. There are certain properties that are built well, they age well, and they keep value for a long period of time. And there are buildings that are not that well built. The quality is lower, you quickly start seeing cracks on the walls, humidity affects it a lot, and the number one thing that determines if the building will be the first one or the second one is the developer. Again, it's not about the size, it's not about the prestige, it's not about the demand for this developer. Some developers are building better than others, and one of the examples of the developers like that is proven by time is Nakheel. And the reason why these properties remain successful after many years is a combination of several things. Nakheel builds the areas, and these are iconic areas. They're one of the best for their target group, Jumeirah Islands or Palm Jumeirah for example. And then they choose the best spots in these areas and deliver strong quality. And there are properties that Nakheel built 15 years ago or even more that keep growing in value now. For example, Shoreline on the Palm. Since 2020 till 2025, it increased in value by 164%. Or Golden Mile, 148% growth over the same period. And it's not like all other buildings in Dubai show the same results. This is an exception that is pretty normal for this developer. Alright, we discussed the worst properties for different types of investors, for different goals. But no matter what your goals are, choosing the right area is critical. We recently made the video about the 7 levels of Dubai areas, from worst to best investments. Check it out.